the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning in to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market closed for the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of some key movements. While Singapore shares rose today as investors continue to mount that move by the US Federal Reserve to hold interest rates. So the benchmark Straits Times Index was up 0.6% at 3,931 points at about 10 a.m. Singapore time. Now let's take you through the closing numbers. The STI closed in the green as well, up 0.57% at 3,930 points. In terms of value turnover, we're looking at 1.42 billion Sing dollars. Now gainers outnumbered losers, 286 versus 243. Top advances for the day, ST Engineering, UOB and Shangri-La Hong Kong dollars. And top decliners we've got here, GMH USD, New Incorporation USD and Hong Kong Land USD. Now in terms of companies to watch, we've got for you Sembcorp Industries, because units of Sembcorp Industries and Sarawak Energy tied up with Prysmian for a hydropower project that could supply Singapore with 1 gigawatt of green electricity from the Malaysian state. Now elsewhere, from the US Federal Reserve holding off on interest rate cuts and the implication on Singapore's banks, REITs and bonds, to how Softbank Group said it would acquire Ampere Computing in a $6.5 billion US all-cash deal. We've got more international and corporate headlines in focus. Plus, how Nvidia CEO Jensen Huang said his company had not been approached about purchasing a stake in Intel. Now, lots to watch, and joining me on the line on a Thursday is Terence Wong, CEO of Azure Capital. Terence, how are you?
Hello, happy Thursday, Tian Tian.
Happy Thursday, and I hope you are happy with what's going on in the US today. We will start with the US this time around because the FOMC, the Federal Open Market Committee, held interest rates this time around. We are looking at a range of between 4.25 and 4.5% for the key borrowing rate. But perhaps what is even more worthy to watch is how the Fed's dot plot showed officials expecting 2 cuts in 2025. So how far is this within your expectations? How did Wall Street and Asian investors react to this?
Well, the markets responded positively to the news that the Fed's 2 projected rate cuts for this year remain unchanged. As a result, most Asian markets actually did well. They were in the green, except for China, Japan, and Malaysian markets. Regarding the dot plot, Fed Chair Jerome Powell, has questioned its usefulness. Previously, he said that if you do focus on the few dots, you may miss the larger picture, and this really highlights the risk of treating the Fed's dot plot as a definitive forecast rather than a general guide. Well, on rate cuts, we remain more bearish, expecting only 1 cut compared to the Fed's projected 2. But we would welcome, being proven wrong if the Fed proceeds with 2 cuts. While successfully containing inflation and avoiding a U.S. recession. Given persistently high prices and ongoing inflation risks exacerbated by tariffs and potentially rising prices, we believe only 1 cut is likely. For now, the economy remains, I think, in a holding pattern. Much depends on how the expected tariffs set to take effect in early April will play out. Particularly in terms of reciprocal trade measures.
Yeah.
There are still many uncertainties, but in general, both consumers and companies have become a lot more cautious. And while current data is stable, albeit somewhat soft, the broader concern is that conditions may deteriorate very, very quickly in the months ahead.
So transitory appears to be the word of the day. But this one, a follow-up question, Terence. U.S. President Donald Trump, he said the Federal Reserve will be better off cutting rates as U.S. tariffs start to transition, and he bracketed this ease ! Their way into the economy. Now, as we know, Trump's policies are said to be inflationary in nature. It could also dampen the health of the economy. So the question is, would the Fed be better off having inflation and cutting rates to boost growth, or would the Fed be better fighting inflation with rates and then run the risk of a stagflation?
Well, to be sure, Trump, even in his first term, he's always been talking about cutting rates, right?
Yeah.
Well, the Fed has reiterated on numerous occasions that it remains data dependent, and I think on this program we've also been using this term data dependent many, many times. Whenever you mention the Fed, right, it's unlikely to commit. Fed is unlikely to commit to a predetermined policy path.
Yeah.
Well, but if the Fed does adopt a specific trajectory, it is likely to avoid stagflation. If you're asking me stagflation, I mean between inflation and stagflation, I think people would be a lot more comfortable with inflation, and they're right. Stagflation presents a significant challenge because policymakers would typically raise rates or keep them high to combat inflation. Yet if unemployment rises together, simultaneously, the Fed would usually cut rates to lower borrowing costs and stimulate growth. In such a scenario, while rate cuts may ultimately be necessary, the process of getting there could involve a period of job losses, and it could be very, very painful for the economy. So ultimately, the Fed must carefully balance the trade-offs between controlling inflation and supporting economic growth. So an approach that considers, the very, very complicated, the very complex interplay between inflation, interest rates, and economic expansion is crucial for achieving this mandate of, or its dual mandate of maximum employment and price stability.
So it's always walking that tightrope between employment and also price stability. But back to the Singapore stock market as usual, Terence, how did the STI fare today? What are the implications of the Fed holding off rate cuts on S-REITs and also the trio of local banks?
Well, as you mentioned, with the Fed still fueling rate cut expectations, STI was pretty much on the roll. It rose 0.7%. On S-REITs, the fund flow basically says it all. Based on the data we track, S-REITs rebounded strongly, with the STI REITs rebounding 5% over the past 5 sessions. And then there's been importantly, there's a net institutional inflow of $50 million. Investors are closely monitoring the factors that could affect REIT earnings. As REITs typically have an inverse relationship with interest rates and bond yields. When interest rates fall, REITs may benefit in several ways. First, the financing cost decreases, and then the dividend yield of REITs becomes more attractive compared to the bond yields, and therefore and what we are seeing right now, attracting capital inflows. Third, a decrease in interest rates usually leads to a lower cap rate for REIT assets. I know a lot of people talk about cap rate, and this is very, very important when it comes to property as well as REITs. So you also mentioned the banks, right? I see some houses, some brokerage houses talking about switching from banking stocks to REITs. Totally understandable, given that banks have been the ones that have been driving STI's growth all the way to record levels, and given that they account for half of the STI, that is really expected that they have been the driving force. But we still believe that actually banks will continue to appeal to investors looking to tide through the volatility, as we think earnings downside risk could be there. And in the general market, so there will be volatility. And as a buffer, its dividend yields are, not too shabby. We're talking about north of 6% for behemoths like the banks. So I believe that there will still be people that are comfortable in keeping banks as part of their core portfolio.
And, Terence, let's zoom in on some of the companies to watch on the SGX. We've got here Sembcorp Industries, because units of Sembcorp Industries and Sarawak Energy, they tied up with Prysmian for a hydropower project that could supply Singapore with 1 gigawatt of green electricity from the Malaysian state. I understand that's pending approvals as well. So how significant is this for Sembcorp Industries if you look at the counter's price movements today?
Price movement, it's up over 3%, right? So I guess the market likes the idea, but in terms of financial significance, it's probably not going to be a game changer.
Yeah.
Look at for attendees for the last Investor Day, they will know that SCI has spoken about how it seeks to raise its capacity by 2.5 folds to 25 gigs by 2028. So this 1 gig, it represents about 4% of the growth that is gunning for. It's something that, while it doesn't exactly move the needle, but it's something that's good to have nevertheless. We project SCI, delivering earnings of over 12% CAGR through the compounded annual growth rate through 2028, driven by its 3 key business segments, which all I think is firing on multiple cylinders. The renewable segment could see profit rising more than 18% CAGR all the way to 2028, and that's backed by the existing project pipeline. All in, if you look at it on average, we're still, like I mentioned, it's going at 12%, and in terms of the numbers, PE is trading at 10 times, and with a yield of 4%, I think, which is quite decent for a stock like SCI.
And if you're just tuning in, we're in conversation with Terence Wong, CEO of Asia Capital. Well, Terence, across the region, China held benchmark lending rates steady for the 5th straight month in March today, matching market expectations. So if we look at the 1-year loan prime rate, it was kept at 3.1%. The 5-year loan prime rate was flat at 3.6%. How far was this to your expectations, and any major spillover impact on Chinese equities?
Well, the Chinese equities for today didn't do as well as the rest of Asia. Some, may argue that, China, Hong Kong market, they are not as correlated as the U.S. market. That's definitely true. If you look at the figures, whether you look at it from a 2, 5, 20-year perspective, the Hang Seng as well as the CSI 300, they are all not that much correlated. Right now, between the U.S. and China markets, we do think that Chinese markets is of better value in terms of valuations. And that's because the U.S. have gone up significantly, and now that there is, Trump and his tariffs coming in the way. Initially, when he got voted in, a lot of people had high expectations for the stock market, thinking that he is going to be very, very positive for the markets. That happened until he started. He started with all these tariffs and all the rhetoric at the start of the year. So the markets have taken, can't say a free fall, but then it has taken quite a bit of a knock. And on this front, the Chinese government is seems a lot more stable right now. And having said that, sustained economic recovery and improving corporate earnings growth are required for, global investors to return to China in a more decisive fashion. Currently, the macro signals remain mixed with persistent price pressures, still becoming an issue, as well as the longer than expected property market recovery. But the government, you can't fault them, because they like I mentioned, if you look into their speeches, the conference, whatever that's happened over the past 2 to 4 weeks, they seem to be putting the act together. And given that the Chinese markets are very macro driven, it's very driven by what the government does and say, that has led to the outperformance of China vis-a-vis the US.
And further away, Terence, let's take a look at Softbank Group, because it said it would acquire Ampere Computing, and that is in a $6.5 billion USD all-cash deal, a big deal over here. And Ampere Computing, as we know, is that US chip startup founded by the former president of Intel. What would the deal mean for Ampere then in terms of the synergies it can tap with SoftBank's portfolio companies and also a chip designer ARM?
Well, since Ampere's processors are built on ARM's architecture, I believe this integration could strengthen ARM's presence in the high-performance, energy-efficient processor market. Furthermore, Ampere's expertise in the high-core processors, could complement ARM's existing portfolio, and the acquisition could really accelerate ARM's expansion into the data center space. Integrating Ampere's advanced technology could also drive innovation within ARM. So all these seems very, very positive. We don't have rating on it, but from what we see, it is a positive move And I guess, it remains, but overall, if you're asking me about the valuations and all, we don't have a view on the company.
Okay. And finally, before we let you go, Terence, let's put on our leather jackets and take a look at what's going on at Nvidia, because it's recently has its developer conference. So Nvidia CEO said during a press conference at that annual developer conference that his company had not been approached about purchasing a stake in Intel. Now, that's when Huang was asked about whether Nvidia was part of a consortium with TSMC to buy Intel. Now, first things first, how would you read into Huang's comments? And the second part is perhaps anything exciting from that developers conference. I know a lot of talk about robots.
Interesting. I mean, acquirers would never admit to the acquisition plans, right? Especially if the target company is a publicly listed one. But taking a step back, we believe that Nvidia is currently comfortable with its existing partnership with TSMC, and they'll probably see little marginal benefits in tying up with Intel, given that Intel lags behind TSMC on the technological front. That said, a few weeks ago, Nvidia was reportedly evaluating test results for an Intel test chip based on the company's next-gen process node. This could potentially pave the way for a future partnership. But even if such a collaboration materializes, it would not necessarily mean that Nvidia will be taking a stake in Intel, unless I think it finds a compelling proposition.
Okay, I suppose lots to watch indeed. Yeah. Thanks so much for the insights, Terence. That was Terence Huang, CEO of Azure Capital. Thank you so much for joining us on Money FM 89.3.
Thanks, Tian Tian.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.